Dear students, welcome to my live teaching learning session of BECE 144 Financial Economics. Today is the third session of this paper, Financial Economics. In this session, you have studied about what is the meaning of financial markets, financial institutions, and financial instruments. How financial market works or what are the main functions of financial markets. In today's session, we will discuss about financial instruments. Financial instruments play a very important role in financial economics. In this financial instrument unit, we will discuss about concept of financial instrument and features of financial instruments. Various functions performed by various financial instruments and the participants who are engaged or involved in financial instruments. Types of financial instruments. What are the various types? We will discuss about these types of financial instruments like shares, bonds, primary and secondary derivatives or instruments. Next is shares and share related instruments. What is the meaning of share price? The nature of risk associated with specific financial instruments. Financial instruments involve so many risks, various types of risk. We will discuss about these risks also. And regulations of financial instruments, how financial instruments can be regulated by RBI or by government. And last is conclusion. So in today's session, we will discuss about all these things. Let us start from first thing. What is the meaning of financial economics, which you are studying? So, introduction to financial economics. You know that finance is the study of how people allocate or distribute scarce. Scarce means limited resources over time. Financial economics deals with the study of allocation of scarce financial resources over time so that we can optimally allocate all the available financial funds in those sectors, in those enterprises, or in those institutions where these funds can be optimally or ideally utilized. So financial economics is a part of economics, is a branch of economics which deals with finance. And finance play a very important role in running all the economic activities in the economy. Financial economics applies the techniques of economic analysis to understand the savings and investment decisions of individuals, the investment, financing, and payout decisions of firms, and the level and properties of interest rates and prices of financial derivatives, and the economic role of financial intermediaries. We have discussed financial intermediaries and financial markets and financial institutions. In this session, we will discuss about financial instruments. Financial instruments is a technique, is a method of various financial things, how we can invest our money in shares, bonds, mutual funds, and other financial asset. So financial economics generally applies on savers and investors decisions regarding how much they want to save their money and how much investor want to invest money in business enterprises. Savers and investors may be different persons or may not be. Generally, savers are household and investors are firms or producing sector. Firms always produces goods and services for the satisfaction of consumers' want. And household demand for goods and services which are produced by producer. But without money, without finance, producer can't produce any type of goods and services and consumer can't buy any type of goods and services without finance. So finance is a very necessary thing in all the economic activities like production, consumption, exchange, distribution, and finance. So financial economics generally applies the techniques of economic analysis to understand the savings and investment decisions of individual, payout decisions of firms, and the level and properties of interest rates and the prices of financial derivatives or secondary markets and the economic role of financial intermediaries. So, financial economics covered all these things like financial markets, utility theory, given uncertainty, financial instruments, and bond pricing and the term structure if interest rates are uncertain or if interest rates are already given. So, this is the meaning of financial economics in which we are studying financial market, financial institutions, financial instruments, and so many other things will be discussed in next sessions. First of all, financial instruments. Financial instruments are those contracts that create both a financial asset for one party and a financial liability or equity instrument for the other party. Financial instruments has two types. One is primary instruments and other is secondary or derivative instruments. Financial instruments can be primary or derivative. Derivative means secondary or derivative means which is derived from the demand of other thing. Primary financial instruments include most basic financial assets and financial liabilities such as receivables and payables and equity instruments such as shares. Primary financial instruments always include shares. Shares are just like paper title document through which savers can save their money in share market and investor can collect money by issuing shares to the public. Share market or stock market is a very wide market and it play very important role in raising the funds for the business enterprises. Through shares, company can raise funds and collect money through those persons who have surplus money or those persons who have surplus funds. They can invest their money in shares and can get higher reward by buying these shares. Company can give dividend, or company can give part of their profit to the shareholders. So shares are generally included in primary financial instruments. Next is financial instrument. We can define this financial instrument in this way also. Financial instruments are those assets that can be traded or buying or selling, or they can also be seen as packages of capital that may be traded. Most types of financial instruments provide efficient flow and transfer of capital all throughout the world's investors. Not only our country people can invest their money in shares, bonds, mutual funds, and other derivative assets. World market, it means all over the world, if investors want to invest their money in these through these financial instruments, they can invest in these financial instrument and raise the funds for the investors. So these assets can be cash, a contractual right to deliver or receive cash, or another type of financial instruments, or evidence of one's ownership of an entity. So financial instrument may be cash instruments, financial instruments may be derivative instruments, and financial instruments may be foreign exchange. So generally there are two types of financial instrument. One is primary and other is secondary. But foreign exchange is also a unique instrument of finance in which we can trade foreign currencies like dollar, euro, and other foreign currencies. Types of financial instruments. Financial instruments are generally primary, which is known as direct instrument. Next is secondary or indirect instrument. Indirect instrument also known as derivative instruments. What is the meaning of this primary instrument? The first main type of financial instrument is primary instrument. In primary instrument, it's a financial investment whose price is based directly on its market value. A financial instrument can be any type of financial investment that is priced based on its market value. If market value is higher, the price of financial investment or shares will also be higher. If market value is lower, then the price of share will also be lower. So financial investment price is based on its market value, and market value depends upon the demand of financial instrument. If demand for financial instrument is greater, market value will be higher and the price of shares will also be higher. If demand is lower, market value will be lower and the price of that financial investment will also be lower. So primary instrument is a financial instrument or investment whose price is based on directly on its market value. Next is derivative instruments. Derivative instruments are those instruments which are derived from the need of any other finance asset or financial asset. Derivative market is a financial marketplace where financial instruments such as option and future are traded. There are four participants in derivative market. One is hedgers. Hedgers are those person or those market which take over all the risk which involved in financial markets or financial instruments. It means all the risk which involved by trading these financial instruments, if these risks are taken by the person who are dealing with these financial instruments, that is called hedgers. Next is speculators. Speculators are those person who want to invest their money in risky assets because profit is risk bearing award. Those person who know about this thing that profit is risk bearing award according to Professor Hawley, though that person definitely invest their money in share market because share market can give you immediate or maximum benefit through investment. If you invest your money in fixed asset or in fixed form like fixed deposit or in banks or at a fixed interest rate, then you will get reward of their money income, but you will not get maximum amount of your invested from your invested money. So speculators are those person who speculate or who gamble through shares and bonds, who invest their money in risky assets to earn maximum profit by investing investment. And third is arbitrators. Arbitrators are those markets who mutually decide the price and the reward of these financial assets. And margin traders are those traders who trade all these financial instruments at margin or at par value. So derivative markets has also so many types. One is exchange traded derivatives. Next is over the counter derivatives. One is exchange traded derivative. Traded derivatives includes the contracts that are managed and regulated by the market. Next is over the counter derivatives. In short form, we can say that this is OTC. OTC is over the counter derivative. Over the counter derivative are private agreement between investors but not traded on exchanges. It's an agreement. It's a private agreement between investors and savers but not traded on exchanges. And the instruments of derivative markets are four. One is options, second is future, next is forwards, and next is swaps. There are four types of derivative instruments in derivative markets. First is options. Options gives buyer right to buy and seller can sell their financial asset at specific date and specific price or rate. So options give facility to the buyer and seller of financial assets. They can sell or buy these financial instruments or derivative financial instruments at a specific date and specific or particular rate. Future instruments or future contracts are those contracts in which We can give right to holder to buy or sell asset at agreed price and date. Agreed price means the price at which buyer and seller both are ready to sell or buy these financial instrument in future, not at present. So futures give right to holder to buy or sell asset at agreed or future price and future time period. Next is forwards. Forwards are same as future instrument. However, they are traded in over the counter derivatives. And last is swaps. Swaps allow parties to swap or exchange their financial obligations. What are the various advantages of these derivative instruments or derivative market? We know that each and everything has some pros and cons, some merits and demerits. Each coin has two sides. Same as derivative market has some advantages or merits and also some disadvantages or demerits. So what are the advantages of derivative markets? Derivative market has so many advantages. One is it ensures ready market for derivative too. Derivative market is that market which is derived from other markets or other financial instruments or tools. Next is it offers lucrative returns or liquidity in returns. Third is it allows risk hedging. It means under this derivative market, risk is taken over by hedgers or those person who take over all those risks who are involved in financial instruments. Next is it allows choice between exchange traded exchanges, change exchange or buying or selling, exchange trade or over the counter derivatives. So derivative market allow us to make a choice in between of exchange traded or over the counter derivatives. And disadvantages of this derivative market is this type of market is too risky for investors because in this market so many risks involved. That's why hedgers play important role to take over all those risks which are involved in this derivative market. So this is the first disadvantage of this derivative market, that in this market there is too much risk involved for investors. Next is experiences high level of volatility. It means this market is very volatile. Volatile means very fluctuating. Fluctuating means very uncertain, unexpected, and there is too much possibility of variations and volatility under this derivative market. Third is not as simple as primary or secondary market. This derivative market and instruments are not simple instruments just as primary instruments like shares. And the activities are similar to gambling but legal. Under this market, the activities which are involved in this, that is just like similar to gambling. But this is not illegal. This is legally permissible by the government. So these are the disadvantages and advantages of this derivative market. And this derivative market or derivative instruments are the secondary instruments of financial instrument. Next is capital market instruments. Capital market is that market in which debt and equity instruments with maturities of greater than 1 year are included. Wider price fluctuations may be possible. Fairly risky investment are also included in capital market instruments. Debt is debenture. A company can raise the funds of their enterprises through debentures and through shares. Debentures and shares both are paper title documents. Both are called financial investment. Financial investment is that investment in which we can invest our money on paper title documents like shares, bonds, debentures, etc. These market or financial market give us possession of these paper title document, and through our investment we can get reward. In debentures, if we invest our money in debentures, then we can get interest at a fixed rate. And if we invest our money in share market, then we can get dividend, the part of the profit of the companies, and we can sell our share when share price is higher, and we can buy shares when price is lower. Then we can earn maximum profit. So capital market is a financial market in which debt and equity instruments with maturities of greater than 1 year and wider price fluctuations and fairly risk investments are included in capital market instruments. Stocks means equity or shares which claims on the net income and assets of a corporation. It means stocks can give you return in form of dividend. If you invest your money in share market or in stock market, then you can get reward as a dividend or profit of the firm or any corporation. Next is mortgage. Mortgage is a pledge amount or it's a collateral which any person who are interested to take money from the investors or who want to borrow money from lenders, we have to mortgage or we have to keep some securities as a collateral to the investors. So loans to households or firms to purchase housing, land or other real structures, we have to give some collateral to banking institutions and other institutions who are engaged in this financial asset business. Next is corporate bonds. Corporate bonds are issued by corporations with strong credit rating. So this is capital market instrument like stocks, mortgage and corporate bonds. Next is financial instruments are generally two types, future and option contracts. Future contracts are those agreements which provide for the future exchange of a particular asset at a currently determined price. It is clear by its name that future contracts will be held in future, and it will be held at currently determined price, but in future. The trade will be possible in future. So future contracts are those agreements which will be held in future of a particular asset at a currently determined prices. A contractual agreement generally made on the trading floor of a future exchange. Exchange means to buy or sell a particular commodity or financial instruments at a predetermined or currently determined price in the future. Future contracts detail the quality and quantity of the underlying asset. They are standardized to facilitate trading on a future exchange. Some future contracts may call for physical delivery of the asset, while mostly others are settled in cash. So, future contracts may call for physical delivery of the asset, or while generally mostly others are settled by cash. These future contracts maybe have long position or short position. Long position means a commitment to purchase or buy the asset on the delivery date, and short position means a commitment to deliver or sell the asset at contract maturity date. In long position, here is a commitment of buying the asset on the delivery date. And short position is a commitment to deliver or to sell the asset at contract maturity date. So this is the type of derivative instrument of finance in which future contracts we have discussed. Next is features of financial instruments. What are the various features and characteristics of financial instruments? Financial instruments may be simple contracts or may be very complicated contracts. Its feature is that financial instruments can be simple contracts or very complicated contracts. Complexity is costly. Individuals do not want to bear these costs. Let someone else do it. And bank's loan can be very complex because the procedure which involved in taking loan from the banks, and if we want to take loan from any financial institution like banking, then bank loans can be very complex. But the non-institutional source in which persons collect money or can get money or borrow money from money lenders, that system or contracts was very simple. So financial instruments can be simple contract or can be complicated. But complexity will be costly and bank's loan can be very complex. Next is standardization. Standardization of financial instruments overcomes these potential cost of complexity. If we standardized these financial instruments, then complexity or higher in cost which involved in these contracts can be minimized. Like US government bonds is an example of a simple contract, and most mortgages feature a standard application with standardized terms. Financial instruments are designed to handle the problem of asymmetric information. Asymmetric information is known as incomplete information. And incomplete information generally is the main cause of market failure. If incomplete information exists in the financial market, then lenders instruments and interest rate swap instrument. Foreign exchange is also a unique instrument of financial market, and commodities in which soft commodities can sell or purchase like wheat, rice, sugar, milk, etc. These are called commodities. Commodity market is that market where goods can be sold or purchased. Soft commodities, for example, agriculture, and hard commodities like natural resources like minerals and others. So these are the various types of financial instrument. One is cash instrument, other is derivative instrument, third is foreign exchange, and fourth is commodity market. The types of derivative instruments are forward, future, option, and swaps. In forward contracts, here agreement to buy underlying asset at a specific rate and specific date also in future. Forward contracts are more flexible than other derivatives. Forward contracts are customizable. Forward contracts are included in over-the-counter trading, and in this forward contract, higher counterparty credit risk involved. Future contracts are those contracts which is just similar as forward contracts, trade on established exchanges, not on over-the-counter trade is possible, traded on established exchange. Parties to contract can't tailor to contractual points. It is fixed. It has fixed format, size, and expiration or expiry date, and it follows daily settlement procedure. Option instruments are those instruments which gives holder a right and not obligations to buy and sell the underlying asset at a specific rate and date, because this is option market, option instrument. So option instrument can give you the right to hold that asset, but will not give you any right to buy or sell the underlying asset at a specific rate and date. It will not give you any obligation. Right is only available to the buyer. For seller, options are an obligation. And option, there are two types of option, call option and put option. Next is swaps. Swaps is generally most intricate derivative tool. It involves exchange of fixed cash flow for a floating cash flow. There are two types of system of cash flow. One is fixed cash flow system and other is floating cash flow system. It is similar to other type of derivative instruments. Swaps can be of commodity, swaps can be of currency, interest rate, and so on. So swap can be of commodity, currency, interest rate, or more. So these are the four types of derivative instruments through which investor can invest their money and borrower can take borrowings from the investors fund. Next is difference between capital market, money market, foreign exchange market, and derivative market. These things, these different markets included different financial instruments. Capital market is that market which traded with capital, or it is known as primary market also because it includes shares, bonds, etc. The participants of capital market is non-financial corporations, banks and depository corporations, institutional investors, brokers and dealers, government, households, and foreign investors. In money market, financial instruments are like certificate of deposits, like fixed deposit, treasury notes, promissory notes, commercial paper, and the participants are non-financial corporations, bank and depository corporations, institutional investors, brokers and dealers. Participants are same in all types of financial markets. Either it may be capital market, maybe money market, foreign exchange market, or derivative market. In all these markets, instruments are different, but the participants are same. In money market, same as capital market, participants are non-financial corporations, banks and depository corporations, institutional investors, brokers and dealers, government, household, foreign investors. In foreign exchange market, financial instruments are US dollar, euros, UK pounds, and other foreign currencies. Participants are same non-financial corporations, banks and depository corporations, institutional investors, brokers and dealers, government, household, and foreign investors. In derivative market, financial instruments are future, forward, options, and swaps. And the participants are same non-financial institutions or corporations, banks and depository corporation, institutional investors, brokers and dealers, government, and foreign investors. So this is the basic difference of these markets: capital, money, foreign exchange, derivative. The instruments or financial instruments are different in these markets. You must have to remember this thing: what type of instrument used by capital market, what type of financial instrument used by money market, what type of instrument used by foreign exchange market, and what type of instrument used by derivative market. Next is international financial instruments. International financial instruments and financial instruments are monetary contracts between parties. They can be created, traded, modified, and settled. They can be cash, means currency, evidence of an ownership, interest in an equity like shares, or a contractual right to receive or deliver cash or in bonds. So international financial instrument include foreign exchange currencies, but financial instruments generally include cash instruments or derivative instruments. Next is financial instrument traded in the stock market. Stock market, we can trade these financial instruments like equities. Equities are the shares in the ownership of the company. Debt securities are the instruments which are issued by the government or companies to raise funds through debt securities. Derivatives are those instruments that derive their value from an underlying asset. And mutual fund is an instrument that collect money from a number of investors and invest the money in various assets. And exchange traded funds, ETF, are those funds or those financial resources of multiple investors are pooled and is later used to buy capital market instruments. So exchange traded funds in this ETF, financial resources of multiple investor. Multiple investor means so many investors can invest their money through exchange traded funds. So multiple investors are pooled or gathered or can save their money in one traded fund, and later on these funds can be used by any business organization or any enterprises, and they can use these funds to buy capital market instruments. So these are the financial instruments which are traded in the stock market: equities, debt securities, derivatives, mutual funds, and ETF, exchange traded funds. Now, what is the meaning of trading on equity? Trading on equity means the use of the fixed charges sources of funds such as debt and preference shares capital along with the owner's equity in the capital structure is described as trading on equity or financial leverages or gearing. Gearing means the profit or loss which involved in these shares are fixed, and the use of the fixed charges sources of funds such as debt. It means here the person who are investing their money in debt or in share market or in preference share, definitely he will get good reward. So there is no risk. So if there is no risk involved in this financial instrument like trading on equity, that is called trading on equity or financial leverages or gearing. Where debt capital is more than 50% of total capital, it is called highly geared capital structure. If debt capital is more than 50%, it means if uh, you have given loan to any investor or business enterprises, then definitely you will get in return a fixed amount of interest. And if you are getting fixed amount of interest by giving uh, by buying debentures or giving your money through debentures or paper title document, that is very sure and fixed, and there is no risk involved in this debenture. So where debt capital is more than 50%, then total capital will be highly geared, means no loss involved in this capital structure. Next is stock exchange, meaning stock exchange is a market, it's a place which provides organized services to trade in listed securities such as shares, preference share, equity shares, bonds, debentures, etc. Stock exchange generally facilitate buying and selling of securities. And securities are paper title documents. Who have the possession of these paper title documents, they will get return or reward in form of dividend, in form of interest payment, etc. As per Securities Contract Act 1956, the term stock exchange is defined as an association, organization, or body of individual, whether incorporated or not, established for the purpose of assisting, regulating, and controlling of business in buying, selling, and dealing in securities. So, as per the doc, doctrary, stock exchange are privately organized market which are used to facilitate trading in securities. Next is role of stock exchange. What is the role of stock exchange? Stock exchange market can raise capital for business enterprises. Commonly, it raises funds from issuing shares, bonds, debentures, etc. Uh, Common forms of raising capital are: one is going to public, limited partnership, venture capital, and corporate companies. These are the different types of firms or market who can get money through shares, bonds, debentures, or through the stock exchange. It mobilizes savings for investment. It creates investment opportunities for small companies, government capital rising for development projects, and it facilitates also companies' growth. So, stock exchange play very important role in mobilizing the savings and investment, in increasing the investment opportunities, in increasing the government funds for development projects, and it facilitates also the company's growth. Next is, what is the difference between bonds and stocks? Bonds issued of debt, it issues of debt, and stocks issues of a stake of ownership in a company. Debt that is made with an investor for cash in exchange for payout of interest, and stocks is a claim to a company's assets and earning that often gives the investors voting right and pay dividends. It's a typically traded over the counter. Bonds are included in over the counter trade, and stocks are included in typically traded through a central exchange or SEBI or stock exchange market. Bonds has lower risk, lower reward. Shares or stocks has generally higher risk, higher reward. Since 1929, have earned around 6% each year. Bonds get reward near about 6% since 1929. And since 1929, stocks have earned around 10% each year, higher reward but higher risk. Bonds has lower reward but lower risk. And bonds can be made as corporate, municipal, or treasury bonds. And stocks are issued by companies at a stock exchange as IPOs. This is the basic difference between bonds and stocks. Next is, what is the difference between preference share and equity share? Equity shares are generally ordinary shares of the company representing the part ownership of the shareholder in the company, and preference shares are those shares that carry preferential rights on the matters of payment of dividend and repayment of capital. When company wind up their business, then company will give firstly amount to those shareholder who have preference shares. So preference shares always get payment of dividend, repayment of capital right according to their preferences. It's clear by its name, preference shares. It means first preference or first payment or first dividend payment given to those shareholder who have the possession of these preference shares. And equity shareholder get reward later on. Next is the difference between preference shares and equity shares. Preference shares are those shares in which holder of these shares do not enjoy any voting right except at their class meeting. Equity share, generally equity shareholders enjoy voting rights. Preference shares have the preference rights as to the payment of dividend. Equity shareholder get the dividend after the payment to preference shareholder. The holders of preference shares have the preference rights as the repayment of preference share capital, but equity shareholder don't have any type of preferences like this repayment of equity share. The rate of dividend is fixed under preference share, but the rate of dividend is not fixed or it may be vary year to year under equity share. Preference shares can be converted into equity shares but equity shares can't be converted into preference shares. So equity shares are generally non-convertible and preference shares are redeemable during the lifetime of the company and equity shares are not redeemable during the lifetime of the company. This is the basic difference between preference shares and equity shares. Next is financial risk. There are so many financial risks involved in this market, but this all financial risk we will discuss in next session. Now we can conclude from this today's topic that financial instruments are those instruments which may be short-term instruments, medium-term instruments, or long-term instruments known as money or capital market instruments respectively. Financial derivatives can be used as hedging instruments and hedging instruments generally take over all the risk which involved in these derivative financial instruments. The basic principles of financial instruments is that all derivatives are carried at fair value with gains and losses recognized in the income statement in the period in which they arise. So in today's session, we have discussed about financial instruments, the types of financial instruments, which are basically of two types. One is primary and other is derivative. But the third type is foreign exchange. And in primary, we include cash instrument. In secondary or derivative, we include forward, future, swaps and options market, and in foreign exchange we include foreign currencies. So in next session we will discuss about other thing like financial risk. Thank you.